Warren Buffett calls it the best book on investing ever written. It was published in 1949, and 3 of its ideas still decide whether you keep your money in the next crash. This is The Intelligent Investor by Benjamin Graham. It came out in 1949, and Warren Buffett, who studied under Graham, still calls it the best book on investing ever written. A lot of it has dated, but a handful of its ideas are the reason careful investors keep their money when everyone else loses theirs. Graham starts with one line that the whole book hangs on. An investment, he says, is an operation that promises safety of your money and an adequate return after proper analysis. Everything else is speculation, not the asset, the approach. You can invest in a share and you can gamble on the very same share. An investor buys a solid business for less than it is worth and holds it for years, collecting dividends along the way. A speculator buys a share because it is going up and hopes to sell it to someone who will pay more. The chart looks the same. The mindset could not be more different. The second idea is his most famous, and it is a character called Mr. Market. Imagine a business partner who turns up every single day and shouts a price at you. Some days he is euphoric and the price is silly and high. Other days he is in a blind panic and offers to sell you his share for almost nothing. Here is the picture. The steady line is roughly what the business is actually worth, grinding slowly upward. The wild line is Mr. Market's price, lurching from greed to fear and back. The business barely changed, his mood changed. And you are never once obliged to trade with him. That is Graham's real point. The market is a machine for setting prices, not a machine for telling you value. When the FTSE drops 3% on a political headline, the companies behind those shares did not get 3% worse overnight. Only the mood did. His price is an offer, never a verdict. The third idea is the one Graham cared about most, the margin of safety. Only buy something when the price is comfortably below what you think it is worth. That gap between price and value is your buffer. It is the same instinct as building a bridge to hold far more than it will ever carry. Say you reckon a company is worth £100 a share, and you buy it at 70. You have a 30% cushion. If your sums are a bit off or the firm hits a rough patch, that buffer is what stops being slightly wrong from wiping you out. Because you will be wrong sometimes. Everyone is. Graham then splits us into 2 camps. The defensive investor wants a fair return with almost no effort or worry. The enterprising investor will pour in real hours of research for the chance at more. Most people, he warns, think they're enterprising when they're really just speculating in disguise. In modern British terms, the defensive path is almost exactly a single, low-cost global tracker inside an ISA, rebalanced once a year and then left alone. Graham was making the case for broad, cheap diversification decades before the index fund existed to make it easy. Buffett read this book at 19 and never really left it. He says 2 chapters are all you truly need. Chapter 8 on Mr. Market and Chapter 20 on the margin of safety. He later tuned the method toward great businesses at fair prices, but the foundation underneath is pure Graham. And if you only ever buy index funds, do not tune out here, because Graham's best lesson is for you. A tracker solves the picking problem. It does nothing to stop you panic selling at the bottom of a crash or piling in at the top of a bubble. Mr. Market still tests your nerve every single day. Our honest take, and we will be blunt. It is a hard read. The prose is dense, and half the examples belong to a market that no longer exists. But the core idea, the price and value are 2 different things, and the gap between them is your opportunity, has aged better than almost anything else in investing. So take the 3 that last. Know when you are investing and when you are gambling. Treat the market as a moody partner whose offer you can always refuse. And never buy without a margin of safety. Ignore the rest of 1949. Those 3 will do real work in your ISA for the rest of your life. Our full written review of The Intelligent Investor is linked in the description. Follow, like, and subscribe for more.